Good afternoon, ladies and gentlemen. It's Jesse Colombo. I'm doing today's closing bell with CTU All Stars. Normally it's Rich and I. Rich had to actually go to another appointment, so there's a lot. At least we have a lot to talk about today. I'm just going to basically do my market update as I normally do, and then I'll open it up so that you can ask me questions about what I'm seeing in the market right now, and also if you want me to do an analysis of individual stocks I can also do that too. I know that's pretty popular. A lot of people like to, throw out ticker symbols, almost like Jim Cramer style. What do you think of Apple? What do you think of Netflix? And I basically go through and do it, chart analysis. So I enjoy doing that. And if you can just think of some stocks you'd like me to take a look at when I'm done with this market update, definitely let me know. But we had a very surprising close today in the market. We opened up the futures were up like 3% or 4% at one point because China cut interest rates last night. And of course, you have all the dumb money thought that that was a good sign. They thought, okay, China's saved, we're all saved, time to buy stocks. And that's the way it was up until the afternoon. And then all of a sudden, you have this massive sell off, and now we close in the red. So it's pretty stunning, but not surprising considering. For me, I didn't believe in this bounce. I know I was saying yesterday how I know the plunge protection team. I don't know. Depends on who you think the plunge protection team really is. Is it the Fed? Is it some combination of the Fed and hedge funds? It's probably a combination. But after seeing so many surprising moves where the market just levitates on no volume, that's part of the reason why you know I do partly believe that it does exist, even though there's no, I don't actually have proof. You can't. It's not like you have a smoking gun or anything. But when you see the market levitate on no volume for no reason at all, you can just tell, and it's usually to the upside. That's usually a sign that the PPT or the plunge protection team is stepping in. But they didn't step in this afternoon. So what's interesting, I actually had my eyes on this pattern as it was forming. I said no, I don't know. I don't know how. I said that would be a little unusual if we saw, a real sell-off into the close, but I kept my eyes on it. Sure enough, it broke that pattern. So this is the intraday chart of the S&P 500. We closed pretty much right near the lows. And looking at it on daily, I have to zoom in for you to really see it better, but you can see the S&P 500 went as high as 1952 or so, and then erased all that gain and closed all the way down. It's just incredible. And just to give you an idea what I'm looking at in the chart right now, I'm looking at this support. It looks like this is support around 1820. So after such a big move as we saw over the past week, it's not it's not surprising at all for the stock market to consolidate a bit, basically, where it's so oversold that it'll probably bounce around for a few days or maybe a couple weeks until it finally is ready to make another move. So if it breaks to the downside, if it breaks below 1820, the next level I'd be watching. Let me see. I have to take a look. I don't even really see a main support level that I'd watch here. I would just watch this uptrend line in the S&P 500. Yeah, that's probably what it is. If it would take out that low that I just mentioned, the October 2014 low, there's a very good chance it'll try to test this longer term uptrend that started at the very beginning of the bull market in March 2009. So that would be the target that I would keep my eyes on, assuming it can take out the low. But definitely, when you see a big bar like this, that's not a good sign. We haven't seen a big down bar like this since the financial crisis. So I do not believe the world is fixed. I don't believe that China cuts rates and all of a sudden everything is fine again. And we've erased the $50 trillion plus debt that the world has taken on since 2007. A rate cut's not going to erase that. But I digress. Let's take a look at the Dow. See Dow, same thing. It had a what was that? A 600 plus point round trip today. incredible. The volatility that we've seen in the past week alone is just, when I was watching that sell-off back in October 2014, I was very concerned. A lot of people were very scared of what was happening, but this just blows it out of the water. It's just a waterfall style decline, really. Let's take a look at the NASDAQ 100. And actually, interestingly, the main trigger of this sell-off for the past week has been China. China's stock market continues to crash as it's been basically doing all summer. It's down something like 60%, and it's down another 6 or 7% last night. So, if you want, I could take a look at some of the charts on that after, and we can, I tell you where I expect it to go just based on charts. But you can see this is the NASDAQ 100, where you have a lot of companies it's dominated by companies like Apple, Netflix, a lot of the tech companies that have been leading the market overall, and they just got, slammed. Even the Nikkei futures, this is Japan's market, did the same thing. You can see it was up pretty dramatically. It was up a good 500 points or so, and all of a sudden it just erased it. Pretty much it just erased it, actually, in the past few hours. But definitely makes for some great day trading, though, when you have that kind of volatility. Let's take a look at the dollar. You can see the dollar's up a bit today, and that's because Japan said that they're willing to intervene in their markets, which means printing money, printing more yen, which weakens the yen, and then boosted the U.S. dollar. So the dollar is still in this wedge type of pattern. And if the U.S. dollar breaks to the upside from here, then that could really punish, or it certainly would punish, commodities and non-U.S. currencies even more, assuming it does break out to the upside, which really still remains to be seen because it hasn't been confirmed either way, to the upside or to the downside. But that's what I'm really concerned about going into the fall, is that if we get another wave of dollar strength, and the reason why could be because you have all this crisis around the world in these emerging markets, places like Brazil, Southeast Asia, obviously China, Central Asia, Africa. A lot of those countries have been hit very hard because their economies were so reliant on commodities prices, and now those commodities prices have imploded in the past year, and now their currencies are weakening. So they're weakening against the dollar, and that pushes up the U.S. dollar. So it's not that the U.S. is doing so well, but it's that those other currencies are doing so poorly. And actually, Reed, that's a very good question. What this is the U.S. dollar index. So it's actually, this is not a currency pair. You could look at the dollar and relative to the euro or to the yen, but interestingly, the U.S. dollar has an index, and what it does is think of this as like the Dow Jones or the S&P 500, but for the U.S. dollar. And what it does is it takes a basket of our most important trading partners, including Europe, or the euro, in this case, the euro, and Japanese yen, as well as Canadian dollar, Australian dollar, New Zealand dollar, and some others, but basically the major trading partners that we have. And then what it does is it calculates what the U.S. dollar's value is relative to those other currencies. So it's not against a single currency, but multiple currencies. And then it's basically an index that shows if the U.S. dollar is going up or going down overall. That's why I really look at it very closely. Because when the U.S. dollar goes up, it's bad for commodities. And when it goes down, it's good for commodities. And same thing for non-U.S. currencies. So I'm watching this dollar chart very closely because this is going to determine what happens. And if you've been following the news at all, you'll hear that a lot of the reason why we had this panic in the first place is because of the emerging markets, China, and commodities meltdown. Here's the euro. You can see the euro spiked over the past few days. And the reason why, it's not because Europe's doing so well, but it's because the U.S. dollar was falling. And that actually helped to push the euro up by comparison. And the reason why was because a lot of people, up until a couple weeks ago, were expecting that the Fed was going to hike rates in September. And they thought it was pretty much a done deal. And that was boosting the dollar initially. And then when we had this panic, now it looks like the Fed will most likely be less aggressive with raising interest rates. And that caused the dollar to pull back a little bit. And then that caused the euro to spike. Let's take a look at oil. You can see oil had a little bit of a technical bounce today. Nothing really significant. You can see oil's still in that downtrend. It's following that channel perfectly. And it's also under this major resistance, which is the lows that we saw earlier this year of $44 per barrel and $42 per barrel. So you can see we're definitely under that. We're also under the key psychological level of 40. So, you know, after a sharp decline, it's not surprising to get a little bit of a bounce, and that's probably what this is. Unless oil, for whatever reason, could finally break back above. But for now, it's still in a confirmed downtrend. And you can see gold fell quite a bit today. And the reason why is because basically what happens in a sharp sell-off, you'd be surprised, but actually gold does not really do that well in a time of panic. I know in 2008 gold fell 30%, and the reason why is because of liquidation selling. That a lot of times in a crisis, when traders and hedge funds and other investors are holding a large basket of stocks and their stocks are tanking, a lot of times they have to sell to raise cash, or sometimes they have to meet margin calls. So gold tends to be one of the assets that they jettison in that type of panic. And they tend to have a preference for holding the US dollar, holding cash, and holding treasuries. So that's part of the reason why gold is falling. You can also see, too, as I've been saying, gold is still underneath that, or bumping its head on that resistance level I showed. You can see for the past 2 years, gold's been in this wedge. It fell under the wedge in July, and then even though it rallied a little bit over the past couple weeks, you can see it's still underneath that resistance level, which was once a support level. So if gold can't break above or hold above 1140 or so, chances are it could keep on heading lower, especially if we see more strength in the dollar, because they trade inversely. All right, so now I'm just going to open it up so that you can ask me different stocks you want to take a look at, or other markets if you want. I can just perform a chart analysis. I just have to get my other charting system up. And just let me know. I know there's a lot of stocks that got slammed over the past few weeks, and you may want to get an idea of where it stands from a technical analysis standpoint. I could definitely give you some ideas on that. Disney, yeah, very good. That's a good one. Disney was definitely leading the market to the downside. It started falling before a lot of the other stocks did too, because media companies started to get slammed. A lot of it has to do with reports coming out that more and more consumers are cutting their cable and going to online alternatives, streaming, Netflix, Hulu, etc. And it's been hurting a lot of the cable companies. But we'll take a look at Disney first, and I'll tell you my ideas on oil, Ray, after that. Just have to zoom out a little bit more for Disney. Actually, let me zoom out even more. It looks like there's a long-term trend line on Disney. Even 5 years, I might have to go. And you'll see why I'm doing this. And this is the first thing I do when I look at a stock from a swing trading, a longer-term perspective. What I do is I just zoom out and try to visualize and see if it's in an uptrend. I want to see if there's any major identifiable trend lines. Sorry, I tried to make that chart a little bit larger, but unfortunately it's not letting me. I hope you can all see it, but Just drawing the trend line. Oh yeah, clear trend line. Look at that. That is what I would pay attention to. You can see back in October 2011, Disney hit a low when it was around $30 a share. And you can see that it's been climbing in an uptrend, and it's been following this uptrend line perfectly. So you can see it keeps on bouncing, 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 bouncing all the way up. So basically, we closed exactly where that, or it bottomed out yesterday exactly at that trend line. So how it acts at this trend line is very important. If it closes under that trend line, that would certainly be a very bad sign. At the same time, because it's above an important trend line, it could bounce for a few days. I wouldn't be surprised if it consolidated for a few days above the trend line. And then I want to see from there if it can either bounce to the upside or break below. And a lot of that has to do with what happens in the overall market as well. But just watch that trend line. That's really key. And also, whoops. You can see Disney's been in a confirmed uptrend because the 200-day moving average is sloping up. But I don't like what happened over the past few days because, or actually the past month, you can see what happened. There's a lot of volume to the downside. So this means that there's been a change of trend, but I want to see if it can break below that longer-term uptrend line to confirm it. All right, Ray, we'll take a look at oil now. Back to the old charts. Show you what I'm looking at here. So there's still a massive glut of oil. I have to see the latest figures, but I know nothing has really changed. There's such a massive amount of oil that's just sitting in oil tanks going nowhere, and there's really been very few signs of a slowdown in oil production. So, and on top of it all, Iran is expected to come online and probably dump, probably in the next 6 to 9 months, probably another a million barrels of oil per day. So 500,000 to a million. I've been hearing various estimates, and that's expected to push oil and keep oil even lower. For now, look what happened. This is the monthly chart of oil. This is going way back, actually. This is as far as I can go on this chart. This goes all the way back to 1991. So you can see $40 per barrel is the key level that I've been watching. And that's actually the price forecast I gave all the way when oil was back in the 70s. I said there's a good chance it's probably going to go down to 40. And the reason why is because that was the high that we saw back in the first Gulf War of 1990. And then that was also a support resistance level going back to 2001, 2000, 2003, and then also the crash back in 2009 during the financial crisis. Also, there's a longer term uptrend line starting in 1999, and then you connect the low of 2002, then you connect the lows of early 2009, and then the lows of early 2015. And look what happened. We broke both of those lines. Actually, the $40 one I didn't draw too well. I have to redraw that just to make it a little bit better looking. But so it just took out major technical supports. It's tough to say exactly how low it can go at this point because now there aren't many identifiable support levels that if you look back in history, there's really not much there holding it up. So I would really watch key levels, like psychological levels, like $35, $30, $25, $20, and so on. Not necessarily saying it has to go that low, but you may be surprised when you see when there's a true oil bust, as we've experienced several times over the past century or so. Oil really goes down quite significantly, and it tends to stay down, especially, if you're interested in oil, watch what the dollar does, because if the U.S. dollar breaks out again from that wedge pattern I showed a few moments ago, that could push oil down into. There's some forecasters who are saying oil could actually go down as low as $20 or even $10. So keep your eyes on that, but we really don't have a lot of support. And let's say for whatever reason oil is able to rise back above 40 and then break back above this longer term uptrend line. For whatever reason, not saying it would, that would negate the breakdown. But for now, the trend is definitely bearish. All right, let's take a look. Rogerio was asking, all my income's from Brazil. When you got to the U.S. 5 years ago, I know. Well, that's what's happening is that you have all these emerging market currencies are weakening significantly against the U.S. dollar. So, whereas from 2001, 2002, up until about 2011 or 2012, you had emerging market currencies were in a bull market, and they were rising, and the U.S. dollar was weakening significantly. Now you have a reversal of that trend. So, all right, let's take a look at Netflix. There's a lot of chart damage right now in a lot of these stocks. Let me just draw my trend lines. So just going to try to draw the uptrend lines for what I'm looking at. See, very similar to Disney, even though it's not anywhere near as long term. You can see there's a clear uptrend line that started at the beginning of this year back in January. You just connect the low in January and also in early April. And you can see that's pretty much where we came very close to yesterday on that sell-off. So I want to see how it acts at that level. Even though we bounced significantly off of it, but you can see it came as low as 85. And it closed at 102 today. So for now, it's still in an intermediate term uptrend, but I want to see if it comes back down to the level and tries to break below. Again, a lot of that's going to be determined by what happens in the broad market, because a lot of these momentum stocks tend to follow the broad market. Any other stocks you want to take a look at? I know there's a lot of stocks that we trade that are momentum stocks. You can just let me know and I'll type it in and take a look at what's going on. What is some of the momentum? Oh yeah, I want to just show you Twitter, because I know we trade that quite a bit on intraday, but it's interesting to see what's going on with Twitter right now. You can see the 200-day moving average is sloping down right now, so it means Twitter is in a downtrend. I can't believe we're at $24, so that's a far cry from where we were back right after the IPO when it was at 74. So it's a third of its value from just under 2 years ago. And I was one of the people who was basically decrying Twitter's IPO, saying it was so overvalued, just like a lot of these tech companies. I was skeptical of it, and really have been skeptical of the overall tech boom itself, because so many of these companies are overvalued relative to their profits, and you can see a lot of the errors coming out of it. And Debbie, it works the same way when you have gaps as far as drawing support resistance levels. I'll show you right now. I mean, I don't like stocks that have these massive gaps in it, but it really works the same way. You try to do the best you can in terms of connecting highs and lows, just like you basically try to connect important pivot points or highs and lows in the chart, and when you draw these trend lines, you want to connect as many highs and lows as possible. Sometimes you have to play around with it a little bit. It's a little more of an art than a science, but Twitter's definitely a choppy stock. But what I found most notable is that it took out 30. And you can see $30 was a clear support level, and that was the low that was reached back in May 2014. And then you can see it just sliced right underneath it. And that was pretty much a bad sign when that happened earlier this month. And then you can see it retested 30, came back up, bumped its head in the resistance, and then went even lower. Went as low as I think $21 yesterday in that sell-off. So for now, the trend is down in Twitter. Ford. Let's take a look at Ford. Well, after the past week's crash, pretty much everything's taken a beating now. That's an ugly chart. I can't believe how, I mean, it just looks so striking when you see how much it came down. I know a lot of that was just pretty much at the open, but that was almost like a flash crash in many ways, what happened. That what happened yesterday reminds me a lot of what was it, the May what day, I forgot what day it was, but May 5th I think it was, 2010, May 10th, the flash crash. That's exactly what yesterday reminded me of. So let me just draw the trend line and Ford. You can see it took out that trend line, the trend line that goes all the way back to 3 years ago, August 2012. You can see it just took it right out. You can see it made a funneling type of pattern or a symmetrical triangle and then just broke right underneath there. So as far as support levels I'd watch would be pretty much $11. You can see it's the low that we saw, or right near the lows that we saw in February and March 2013. And I would watch 13 as well because there was a low, there was a couple highs and lows right around there. I'd want to see if it can hold above 13, close back above 13, or if it can't, then I'd watch 11. Just basically watching key support resistance levels on the chart just by looking at prior highs, prior lows, and also major round numbers. Any other stocks you folks want to see? Oh, Shaq. Oh, yeah, Shaq. Let's take a look at Shaq. See, the thing with IPOs, especially recent IPOs, is that there's such a short trading history with it that it actually becomes difficult to draw. You don't really see long-term trend lines in something that's only been trading for 5-6 months, but I would still watch. See, what I would do in this case would be obviously watch major round numbers, major whole numbers like $40, $50, so on, but I would look at the highs and the lows. So right now I'm looking at, looks like 40 is going to be a key support level because it pretty much marked the lows that it reached back right after the IPO in February. And that's also the nearest round number to those lows. So that's going to be an important support level. And if it breaks below 40, then I would expect it to probably drop even further. But definitely pretty messy to go from 95, almost 100, all the way down to 40. You know, that's what I've been saying, that a lot of the IPOs in recent years are very overvalued. There's been too much hype over IPOs. You know, it's almost like not quite as bad as the late 90s, but there's a lot of, it's just too much froth. And they're coming out with these massive valuations, and then it's not surprising when these companies come back down to planet Earth. All right, let's take a look at Loco. You can see Loco's in a clear downtrend. You see the 200-day moving average sloping down. Let me go back, I think just one year. All right, 1 second. Interestingly, what it did was actually back here, back 1 year ago, you can see it made a symmetrical triangle and it broke down from there. And that's basically similar to what I call a funnel pattern. Like a lot of times we'll see those patterns forming in Cyber Group on the stocks that we trade intraday. You'll also see similar patterns on daily with these stocks, and you can see, sure enough, just take a look at that, and sure enough, it broke down pretty significantly from there. Then it also formed a channel type of pattern, and you can see it broke down from there. So I'm not seeing any major trend lines or support resistance levels, etc. So it's really hard. There's really not a very long price history with this stock, so it's hard to really get a grasp on it. So I would just watch major round numbers like $10, $11, $12, and so on. Yes, Rich, I definitely I want to make a point to actually become more involved with options, especially non-directional strategies. I've been doing a lot more research. I mean, I have traded options, obviously, but mostly directional, like puts and calls. I want to get more involved with spreads, iron condors, etc., so I can apply a lot of my knowledge or outlook with options. So that's it's a work in progress. Definitely something I want to continue on with. Any other stocks you folks want to take a look at? Any briefly? We can just take a look and yeah, hey, definitely. Once I get to a point of mastery, I'll definitely do a workshop on options, no doubt. And it works very well with my, with the way I look at volatility, the way I look for these volatility squeezes, which I discussed actually in my workshop earlier today, where I look for volatility squeezes using Bollinger Bands, and that it's very helpful because it tells you when there's likely to be a big move. So I believe it's got a lot of promise where you could put on an option spread ahead of a big move and then profit as long as it makes a big move. It doesn't have to go in any one particular direction as long as there's a significant directional move, which tends to happen after those volatility expansions. Any other stocks you'd like me to analyze? Oh, yeah, TVIX. Well, I'm not going to look at TVIX itself just because it's very leveraged, so it tends to distort the chart. But what I'll look at actually is the VIX, and that's what TVIX is based on. Wow. Yeah, TVIX is based on the VIX. That is an incredible move. I'm just trying to go back 5 years to get an idea. Wow, that blew the summer 2011 downgrade volatility surge. It just blew it right out of the water. Incredible. I want to see what that looks like compared to the financial crisis. Actually, that would be really interesting. Let me see. Let me try to get a longer term chart. Yeah, that's definitely a sign that things are not well in the world right now. Interesting, because this one shows it that it didn't rise quite as much. I wonder if there's a difference in the methodologies behind them. Apparently, this was the one. I don't know. I'm kind of confused. Maybe they calculated a little bit differently. What do I think about the CBOE? Reddit went up 90% yesterday. Well, the CBOE is just the Chicago Board of Options Exchange. It's an actual exchange itself. Do you mean the CBOE VIX index, the volatility index? That might be, I think. Yeah, that's probably what you meant. Yeah, exactly. That's what we're looking at right now. That's the CBOE volatility index. Yeah, that's what it is. So what it does is it's a fear gauge that measures volatility in the options market. And when the market plunges, volatility goes up. And when the market goes up, traders are no longer worried, so volatility goes down. And you can actually trade volatility by trading TVIX. And then there's VXX. There's a lot of ETFs that track volatility, where if you expect there to be another sell-off in the market or another fear event, one way of actually profiting from it is you can short the market, but another way is you can just buy an ETF like TVIX. But I would not swing trade those volatility ETFs, and here's the reason why. Because if you look at it, over time, these volatility ETFs tend to actually decline very consistently. So you can see it's now right now it's only at $14.60. But according to this, pretty much at its inception back in 2011, it was at $110,000. I know they've done reverse splits, but the reason why this happens is because in order for this company, Velocity Shares, to produce this ETF, they need to go into the derivatives market and start using all sorts of exotic derivatives. And that costs this company a lot of money to put on those hedges, those insurance contracts, basically. And what they do is they pass that on to the consumer. And the way they do that is by steadily reducing their price. So if you hold it over the long run, even if you're right and there's some sort of a volatility spike, you can still lose money because this stock continues to drop for years and years and years on end. So it's great for intraday day trading, but I would never hold it for more than even if you're swing trading, maybe I would limit it to a week or two at most, because they're the decline of these ETFs is just a function of time, basically. Yeah, and TVIX gapped down because the reason why is because the market surged, the futures surged. So optimism came back temporarily, and then people wanted to sell volatility. Yeah, Dave, that's actually no, that I actually appreciate that. That's a really good idea because I'm always looking for workshops to do, and there's a lot of people so bewildered by all the ETFs out there. There's like so many different options on so many different types of ETFs out there, and I could definitely go through and just explain the different ETFs, which ones may be good for day trading, what to look for. Yeah, definitely. So, all right, folks, I have to cut it short because I have to go to an appointment this evening, but as usual, if you have any questions, just email me at jesse@ctutrading.com, and you can always ask me my daily updates as well. And also, if you want to set up private one-on-one coaching, email me there as well. So I think tomorrow is going to be very interesting in the markets. I want to see if there's going to be a little more of a downside follow-through or what happens, because we had this massive sell-off toward the end, and I want to see how that plays out. All right, thank you so much, everyone. Have a great night.